Good morning, everybody. Firstly, apologies for my voice. I haven't been raving all night. I've had a few presentations on lately, and it's a little scratchy. So apologies. Thank you for joining this morning. As you know, multi-asset investing has been part of the UBS DNA for over 30 years, and in fact, globally, we've been doing multi-asset investing for nearly 35 years, and certainly in Australia, we've been doing multi-asset investing for nearly 25 years, with our traditional balanced and defensive investment funds being incepted in 1992. Over this period of doing this, we have seen, or certainly have evolved ourselves a great deal in the way that multi-asset investing is done. But in a way, this evolution in the way that multi-asset investing is done is in part a reflection of the evolution in financial markets themselves. And so that's how I'm going to structure this presentation, by putting it all into context with regard to how we've evolved in the markets and what kind of features have been adapted to the multi-asset investing process as a result. So just to kick off with the first slide, certainly markets have evolved quite significantly most recently. We're in a situation that we never thought we would be in on a number of different aspects of the market. We never thought that we would see the day where bond yields can go negative, but certainly that's the situation that we're in, where, globally we have around $7.5 trillion worth of bonds out there that have a negative yield. We're also seeing the fact that the US now has become the world's largest oil producer, having overtaken Russia and Saudi Arabia last year. Interestingly, we also never thought we would see the day where a reality TV star could potentially become the President of the United States, but that is also where we are, and certainly underpinning that is the fact that we've had a depletion of political capital following the GFC, and a rise in discontent that's coincided with an increase in inequality, and this is really affecting global politics. We're now in a situation where interest rates can go negative. Certainly that's been the case in Europe and Japan, and we're now also finding ourselves where central banks themselves can become asset managers. The sheer act of quantitative easing implies that these central banks are loading up on assets such as bonds, and in the case of Japan, they're loading up on equities as well. We now find ourselves, in fact, with Japan being the largest single shareholder in the Japanese Nikkei complex, and certainly they are running out of bonds to buy as well. So we're in interesting times, and markets have evolved a long way, and so as a result, the way that we invest needs to also evolve, and this is one of the benefits of being with an asset manager. We can evolve as markets do evolve. What I want to do is take you back to the early days, certainly our early days of multi-asset investing, a look back at a period that was colloquially known as the Great Moderation. This is a period from around 1987 to around the start of the 2000s, where we had very high economic growth and very low volatility. There was a great deal of optimism around. We had Bill Clinton, President of the US. Tony Blair was in office in the UK, so there was a great deal of youthful enthusiasm from a political standpoint. But also both of these two politicians believed strongly in free market ideology. And that was certainly backed up by the thinking of the US Federal Reserve under Alan Greenspan. There was a very great deal of thinking around this, this free market idea. And so Bill Clinton was instrumental in cutting or taking a chainsaw, if you like, to financial regulation. And so there was a great deal of deregulation happening at the time during the 1990s, and most importantly during Clinton's second stint in office in 1999, he repealed the Glass-Steagall Act of 1933, which was implemented after the Great Depression, in fact, to separate the banking activities of banks between their deposit-taking activities and their investment banking activities. When Clinton repealed that act, it meant that banks could now cross over and do both. And of course, as we now know, that laid the groundwork and foundation for the surge in securitization and what we now have come to realize as being the start of the mortgage crisis in the US. Also at this time, you know, China was coming into its own and was coming into the World Trade Organization and beginning to seriously open up. And also, interestingly, oil prices were averaging around $35 a barrel back then over that time period as well. It got to a low of $16, in fact, in December 1998. And that also led to a period of low volatility. So what did this mean in terms of the industry structure and also mindset? Well, it was fairly simple times. In fact, there were two major asset classes. There was bonds and equities. Asset allocation was practically non-existent, given that there was only these two real asset classes at the time. Investors spent 80% of their time on equity manager selection and just 20% of their time on asset allocation. And even then, asset allocation involved broadly just the choice between the two asset classes. Interestingly, based on data from Towers Watson, in 1995 the average allocation to alternatives was just 5%. So this compares with around 20% today. Also, the fact that we had high growth, high returns, low volatility, it meant that the market ideology was one of buy and hold, set and forget, effectively. It was possible to get risk-free returns. The market was very liquid there because of the deregulation that had occurred with Bill Clinton. And certainly the high returns meant that it was pretty easy to get. Sharp ratios were quite high as a result. Looking at the actual returns at this time in an environment where market returns were higher and volatility was lower, you can see here in the chart on the left-hand side, in the 1990s, equities, and I use US data here because that's the longest history that I have, but US equities averaged over the 1990s 16.1%. That compares with a very long run average for US equities of 6.6%. Bonds were returning just as high as what, well, almost as high as equities, 7.7% compared with their long run average of 2.6%. So it was very much of a high returning period. But also because of the low volatility, drawdowns were quite rare. And so the bar chart on the right-hand side is the frequency distribution that shows you that fact, that actually drawdowns were rare, and when they did happen, losses were able to be recouped quite quickly. This chart shows you what would happen if you invested $100 at the start of the decade, and you can see pretty clearly that the S&P 500 would have given you a total return of 450%, which is not a bad return. but even bonds gave you a 100% return over this period. So you're starting to understand now that the 1990s was quite an unusual period, a period of very high returns, very low volatility, and so as a result, it was a fairly simple time in terms of diversified funds. This next slide here therefore shows where we were at this time in terms of being a multi-asset manager. This is the first generation really of diversified funds, where the building blocks were pretty straightforward. You had Aussie shares, international shares, property securities, DFI, which combined fixed income all in one. So you had not only Aussie bonds but international bonds, and also credit was also considered in the one basket there, and also cash. The donut charts on the right there show you the breakdown of the different sleeves that the multi-asset managers were using at the time, and then inside the donut it shows you where the returns were coming from. And at this time, a large part of the returns were really coming from the benchmark. 75% of returns were coming from the benchmark, and certainly why not? This was a period of buy and hold. You just had to be in the market to do well. You didn't have to really do anything smarter than that. Each building block was often actively managed by different portfolio managers, but inside the same asset management firm. And so that meant that asset allocation decisions were made jointly around a table of all of the individual portfolio managers deciding on the broad asset allocation. And that necessarily therefore implied, because that's how decisions were made, actually asset allocation wasn't that dynamic. It was a fairly slow moving process. You got together once a month, maybe once a fortnight, but again, because you could set and forget, you didn't have to be very dynamic. And similarly, the risk donut underneath the return donut shows you where most of the risk was coming from. And again, similarly, as with returns, most of the risk was coming from the benchmark. And then we fast forward to the first evolution in the multi-manager design. The basic building blocks were still very similar to what we had previously, but the difference now is, well, there's two main differences really. One was the outsourcing of active management of each sleeve to an external manager. Of course, this was possible because returns were high, and so you could afford to spread your fee budget around. The second major change was that the manager of the multi-asset fund now had two decisions to make: external manager selection and asset allocation. Of course, the focus at the time was on external manager selection. The idea here with bringing in external managers was to increase the diversification of the different sleeves in order to try and reduce the volatility of the alpha from the active security selection. And so you can see here now in the donuts, the top donut is very similar to what we saw in the first chart, but the second donut now shows you that the active risk from active management of the external managers has now reduced, has decreased the volatility of the alpha. So we move on and away from the Great Moderation to now a period that you could call the Great Volatility, where we have had the GFC, where the world was on the edge of the cliff. We had the Euro crisis, the Greek crisis, the taper tantrum, the decline in growth in China. We've also had a situation where we're finding increasing income inequality post the GFC environment, so this rise in political risk. as well, and so that's starting to influence government policy, and also to some extent the free trade and the ability to implement free trade agreements, as we're seeing in the US political race. You know, a situation now where is it really possible for somebody like Donald Trump to become president of the US? We've moved quite a long way away from where we were, and so necessarily then we need to evolve in the way that we think about multi-asset investing. So now we turn to a situation where we have more complicated times. We now have many more investment classes to manage. The investable universe has expanded to include new strategies and asset classes, including real estate, hedge funds, private equity, currencies, commodities, natural resources, and infrastructure. Explicit allocations are now made to alternatives and to illiquids, because post-GFC we now have a rise in regulation, which necessarily implies that you can't take market liquidity for granted anymore. It is possible, in fact, to get return-free risk investing. Financial innovation did result in the rise in securitization, and that then led to the complicated products like CLOs, CDOs, CDO squared, etc. The overarching search for yield by investors has resulted in asset classes now becoming more granular as investors become more discerning in the risks that they want to take and the risks that they want to hedge out. So with more levers to play with in the asset allocation decision, keeping track of where the risks are and the interplay of these risks in a portfolio setting necessarily now requires the use of more sophisticated risk management systems. In a low returning environment such as the one that we are in, investment management costs now become more apparent. Investors need to now think more carefully about where they want to spend their fee budget. So increasingly investors are choosing to reduce the number of single sector active managers that they have and invest more in one or two multi-sector managers. In this environment, it's no longer sufficient to set and forget an investment strategy. This is most important in a world where equity investments can lose you money over a 10-year period. Bonds are not necessarily risk-free investments, and as I said, where liquidity cannot be taken for granted. Investors now need to be more flexible, they now need to be more nimble, and most important, they also need to be more liquid. Looking at a comparison now of the returns in the period of the Great Volatility. Similarly, the average return for US equities over the last 15 years is just 3.8%. Remember, in the 1990s, this average was 16.1. For US bonds, the average is over the last 15 years 5.3, compared with 7.7% in the 1990s. So more than that though, more than just this lower return environment, we're seeing with the frequency distribution on the right that sell-offs are more present and take longer to recoup. So this necessarily brings to the fore risk management. The same sort of chart now shows us the picture in reverse. Bonds are now the top line. If you invested $100 in bonds in January 2000, you'd be up to 150% by the start of this year. Equities, in contrast, up just 50% over the last 15 years. So it's quite interesting, the change in the environment that we're in. This necessarily requires multi-asset investors to evolve to the environment that they're now in. So now we move to the second evolution to respond to this environment. Now a number of changes have been made. Each building block is now managed in-house increasingly in order to try and conserve the fee budget. New instruments are being taken advantage of, such as derivatives, which means that asset allocation now can be more dynamic. It's no longer a monthly meeting or a fortnightly meeting or even a weekly meeting. It's now a bi-weekly meeting and looking at it every single day. This as a result of bringing the management of the individual sleeves in-house necessarily therefore implies that the in-house teams are getting bigger and are becoming broader. And so you need to now have larger teams of multi-asset investors who are spread more around the world in order to try and find the ideas. And currency too has become a far more important part of this picture as a way of diversifying the overlay and to help to reduce the amount of risk in the portfolio. And then to one of the most recent evolutions that we've seen as a result of this new environment. Now the evolution is the main change that we've seen as a result of new instruments that have become available, the growth in particular of ETFs and the rise in liquidity and availability of these instruments means that now in a low growth environment where we're concentrating on the fee budget, we can build a more efficient portfolio. And so that's where we're using the new instruments such as ETFs to improve the design of the multi-asset fund while still maintaining an active asset allocation over the top of it. So you can see here the building blocks still remain pretty much the same, although we're breaking out increasingly individual sleeves out of each of the broader buckets. So investment grade now and high yield, and many managers in fact even break that down even further into bank loans and infrastructure debt. Each building block is made up of passively managed sub-funds that can be implemented using ETFs. And now the asset allocation decisions can be active or passive. So you can make the passive changes to the SAA, or you can be far more dynamic over the active part using derivatives to make very quick and nimble changes to the TAA. Now this contrasts with a lot of other competitive funds that manage with fixed allocations against the benchmark, which tend to be still reviewed in the traditional way quite periodically. So the aim of this evolution now is to minimise the cost for investors whilst also maintaining a fairly low level of active risk. But you can see there in terms of the total return, still most of the return in these funds is coming from the benchmark. So now we can have a look at the comparison of how each of these evolutions have performed. And you can see here this is a risk-return comparison. You can see the best portfolio is absolute, and in risk-adjusted terms is the Dynamic Allocation Fund, which is the top line there, the lighter blue line that shows you that actually it's not surprising that that one is the best performing fund, certainly on a risk-adjusted basis as well, because it's the most active. You have active management in equities, in bonds. You have far more active and nimble management in asset allocation and also in currency. So that's a significant improvement over the multi-manager model and over the original global balanced model. The lower cost evolution is, in terms of adjusted for cost, is the better performing fund if you adjust for the cost, because whilst it doesn't have the active management over equities and bonds, it still has the very active management over asset allocation and over currency. For us at UBS, our heritage, as I said at the introduction, stems back to 1992, where we incepted these two funds, which are our Balanced Investment Fund and our Defensive Investment Fund. These funds are a very effective choice for long-term investors who want a more traditional type of balanced fund where you have active stock selection in the underlying sleeves, you have active allocation over the top of it in terms of derivative movements and currency movements, etc. These two funds, in fact, are two of the longest running balanced funds in Australia. So now we find ourselves once again in new territory where some central banks have gone from zero interest rate policy to negative interest rate policy. The use of unconventional monetary policy has become widespread. We're now experimenting with these new tools. In addition to that, China is continuing to slow. The world is still in love with debt. The total stock of non-financial government debt, in fact, is up more than $50 trillion since the GFC. So we're also beginning to perhaps appreciate the quantitative limits of quantitative easing. Japan, for example, is running out of government bonds to buy. Europe is still not out of intensive care, and the US is struggling to generate a self-sustaining recovery. So being in this uncharted territory means that correlations, historical correlations, can no longer be as relied upon as what they once were. And so we need to now think about risk from a different perspective. This chart here shows you the kind of environment that we're now in. We're now in this lower real rate environment. The RBA has said that it seems plausible that the average return on savings, at least for a protracted period, will be lower than it has been previously. That's a direct quote from the RBA. So we're in this lower for longer environment. Lower returns, lower yields, and lower growth are all being driven by underlying structural changes in global economies. Aging demographics, excess capacity as a result of the collapse after the GFC, and tighter regulation, which means less bank sector leverage. This means for investors that we're now closer to the zero line, which means that risk management and the focus on risk management has necessarily increased. Managers now need to be as risk management focused as they are return management focused. And just to give you an idea of the kinds of risks that investors are now facing in this environment, because we have had this search for yield that's been around now for about a decade. Investors have been chasing yield, necessarily putting pressure on down bond yields as a result. The problem with that is that the bond yield has traditionally acted as a yield cushion for investors that will offset against any capital losses in the bond. So this chart here shows you that the yield cushions have now shrunk to very low levels. So for example, in Japan, the 10-year bond yield need only increase by 1 basis point for an investor in Japan to have a negative total return on their Japanese bond fund. It's a better situation in Australia, but it's still not great. In Australia, the Australian 10-year bond yield only has to rise by 30 basis points. So that effectively means that the yield on the 10-year bond only has to go from 2.5% to 2.8% for an investor to have a negative total return on their bonds. This is a vastly different environment to where we were back in the 1990s, when in fact the yield on bonds was 7, 8, 9%. This was a great big fat cushion that would offset any capital losses. That cushion is very, very thin right now. So we need to change and evolve the way that we think about managing. We also, therefore, being closer to the zero line, we have to be careful about the benchmark that we choose. The choice of the benchmark matters. It matters not only because we are closer to that zero line, but it also matters now because our investors are now older. And that necessarily implies that their investment horizons are now shorter. Investors can no longer necessarily afford to ride out the cycle. And so we need to be careful about what kind of benchmark we're managing against for these kind of investors. And this chart here shows you, for example, global equities benchmark on a rolling 10-year period would have 26 down periods out of the total. So 8.9% of the time you would have a negative return. Are your investors comfortable with that? So this is the kind of environment that we're in. And I think actually we have seen an increase in absolute return funds, because now the benchmark is critically important for investors. They can't afford to have the negative returns. So we move on to needing to focus on the importance of risk management, and I don't need to highlight this too much to most people. Everybody appreciates that you know, a loss of 10% means that you necessarily have to have a gain of 11% to get back to your starting position. So the way of almost winning in this environment is by not losing. Have to focus on risk management. A 20% loss, for example, you need a bounce back of 25%. In the space of 18 months, the GFC wiped out over 50% from the Australian share market. The All Ords is still languishing some 20% below its 2007 peak. It's 8 years, and still we're not back to break even. So you have to wonder how many more years it will be before the 50% loss is finally recouped. So we're now thinking new generation multi-asset investing, where we have to now think smarter and look further for the ideas. So the implications here are that increasingly we need to be unconstrained from the benchmark as much as we can. We need to look into as many different asset classes and markets as possible, and looking at mixing directional risk with linear trades and relative value trades and pair trades, looking at being as unconstrained as you possibly can. Of course, the choice of the benchmark is very important, but also having wide bands around that benchmark is also critically important now, in order to allow the manager to look far and wide for the new ideas, because the ideas are not as easy to come across as what they were in the 1990s. This necessarily implies that you need to be flexible. You have to be flexible in the choice of instruments that you choose, the kinds of instruments that you invest in, whether it be ETFs or futures or options. You need to have a nimble, tactical asset allocation. And so this has required a restructure of the way that multi-asset managers are structured and the way that they think. We're meeting formally twice a week now, informally on a daily basis. You have to take into account the liquidity of each instrument that you're investing in. It's not as simple now of just going into high yield bonds, for example, and thinking that I'm going to pick up a nice attractive yield off that. You have to think about what is it going to cost me to get out of this investment if we are in a period of stress. And risk management is important. Tail and event risk hedging is becoming far more important. You need to look at scenario analysis, you need to look at stress testing, but also you now need to look at far more forward-thinking risk, such as risk mapping. How would my portfolio respond in this kind of environment given the new correlations that we know are now evident? You know, historically, oil prices and equities have been negatively correlated with each other. A fall in the oil price meant an increase in equities. That's no longer the case. It's now positively correlated, and we need to adapt to that. So what does this mean for managers? Well, it means that you have to be as diversified as you possibly can. Diversified across the kind of trade that you're doing, whether it's directional equity trades or credit trades or relative value, currency or market trades. You have to be diversified across time, having individual trades in your portfolio that will come due at different points in time so that you can avoid cluster risk. And you have to be diversified across the instruments. You have to be allowed to implement using futures, for example, when your conviction is very high and you understand the road ahead is very straight. But at other times where you have less conviction and there's potentially some grayer clouds out there, you might want to implement your trade ideas using options. You have to be allowed to do that. And then thinking about risk in terms of risk budgeting, building up the risk from each of your individual trades so that then you can maximize the benefits of diversification. This next chart is an interesting one, and it shows you the cost of constraints, the cost of constraining a manager to a benchmark unnecessarily. This line here is the duration for the Australian bond composite index. And you can see right up until the GFC, the duration on this index was fairly static at around 3.5 years, which basically implied that if you had a 1% rise in yield, the capital loss on your index would be minus 3.5%. Now, back then, of course, you had higher running yields, so hopefully you had a running yield higher than 3.5% that would offset that, so you'd still be in positive total return territory. But now, since the GFC, governments have been issuing longer dated bonds, and so that has implied that the duration on the benchmark has now increased, and we're now up to 4.6 years, which means that a 1% increase in yield causes your portfolio to go down in value by 4.6%. You can offset that to some extent by the yield, but when you've got a yield of 2.5%, you're still in negative total return territory. So this is the risk of, or the cost of constraints. Even a passive investor in the Australian bond index is increasingly taking on more risk, quite possibly without even knowing it. So benchmarks are very important, and I often say benchmarks are not a risk-free starting position. You have to appreciate where you're starting from and understand the benchmark that you're using. risk management has increasingly been integrated into investment management teams. It's certainly the case at UBS, where we have our own risk team who have built our own proprietary global risk system. And this is important because this team sits beside us. They don't necessarily monitor us. We have a separate risk team to do that. But this team sits beside us and they help us in things like designing the trade, in things like portfolio construction, optimizing the risk and return profile and identifying the sources of alpha in the portfolio. Where is the risk coming from in this portfolio? And also in tail risk management, where we want to identify the tail risks that are potentially out there. For example, a collapse in growth in China is one such tail risk. How should we best hedge against that tail risk? And of course, we're asset managers and you can't hedge against all of the risks, but having a risk team integrated into the return management process means that you can identify the risks and then identify the best way of hedging out the ones that you don't necessarily want to take. The end game, of course, is trying to achieve this asymmetric portfolio, and this is what risk management and certainly drawdown risk management is all about. It's trying to ensure that you have more upside returns than downside returns. So you want that smile. This portfolio here was put through our stress test, and it shows you that you're not going to win or lose by the same magnitude in an up or down market scenario. The magnitude of the up scenario is far greater than if you got a down scenario and where you would lose. So you want that asymmetry to be working for you in your portfolio. So another way that some managers are thinking about managing multi-asset investing is through risk parity, and you've probably heard of some of the risk parity funds that are out there. The traditional approach would have you allocate your FUM across asset classes, and your risk contributions would therefore be implied from that. That's the traditional way of thinking about things. Risk parity thinking has you allocating the portfolio across risk factors, and then your asset allocation is implied out of that. We at UBS, we do this to an extent where we look at the kind of risk factors that we're happy to take, whether it be equity risk or duration risk, and then we think about what is the best way of capturing that equity risk. It's not necessarily by buying equities, and in fact in our portfolios today we're quite happy taking equity risk, but not through equities. We have equity risk through our credit allocations in the fund rather than through equities. So this is a different way of thinking about risk again. I'm going to finish there, but just emphasizing the journey that we've been on. Markets have changed dramatically since the time that UBS first started to do multi-asset investing in Australia in 1992. Things are significantly different now, and so that necessarily implies that the way that you do multi-asset investing has to evolve as well. We now have to be far smarter and think in broader terms with a risk management hat on than ever before. I'll end it there, and happy to open it up to questions.
Great, thank you so much, Tracey. We do have a couple of questions on the line, and I'm sure more will come through at the end now, as they often do. The first question is from Tony, and he was referring to the slide about evolution number 2 and asked, do the returns on the charts include dividend income or just growth in value? I'll let you flip to the right page to see what Tony was referring to.
these returns, they're simulations, but they are total return simulations. So they include capital changes in the capital value as well as adding in the income. So it's a total return portfolio.
Great. One question, why do you think that ETFs are having such a strong period of popularity? You mentioned that they are quite popular at the moment.
I think because the environment demands it. I think everybody now, the tide has gone out on easy returns, and so costs are now far more evident. So people are looking for efficiency gains, and the most efficient way of getting exposure to the market is through these ETFs. And so it's no surprise to me that ETFs are booming, and it's going to continue. It's a nice way, it's a cheap way of getting a diversified exposure to the individual markets that you want. But also I think because we have seen a rise in multi-asset investing, people are no longer just picking and choosing the individual managers to manage the different sleeves. Now you've got to conserve your fee budget. So multi-asset investing has increased, and I think increasingly what we'll see is that these multi-asset managers are doing what we're doing, and that is using these ETFs to build efficient portfolio as a starting position.
Wonderful. You also mentioned that risk management is particularly important in the current environment. How can financial advisors basically minimise the risk for their clients? What strategies can they use?
Well, I'm an investment manager myself, and I hand over my portfolio to somebody who's looking at it on a day-to-day basis. This is not the environment to be trying to pick the turning points, because it's very easy to be whipsawed in this environment. It's also an environment that's not necessarily being driven by fundamental factors. We saw last month, for example, the Brazilian equity market was up 17%. I cannot explain that. The economy there is on its knees and the president is about to be impeached, and yet equities are up 17%. So I think the best way, the most efficient way of managing in this environment is to give the portfolio to a manager who is global, who is looking at this on a day-to-day basis, who is changing the weights on a day-to-day basis, who is having the conversations with somebody who is sitting in the UK about the risk of Brexit and what that can do to the risk-on, risk-off sentiment. I think it's absolutely critical that in today's environment that managers need to be as close as they possibly can to the portfolio. And if that is possible for an individual advisor to do, then my hat's off to them. But it's very time consuming, and so managers now are spending more and more time being as close as they possibly can to the portfolio and to the decisions that they make.
Great. And we've just had one come through that I think refers to our previous question around ETFs. Ewan has asked, would small cap get popularity? I think, meaning, is that quite popular at the moment?
I think one of the things you need to be careful of with these ETFs is their costs, because it kind of defeats the purpose of investing in an ETF, and also the liquidity of them. So these are the two things. Whenever we're thinking about a new instrument to invest in, we look at the transaction cost, and then we also look at the liquidity. If we're in a stressed environment, how difficult is it for us to get out? I think small caps, that's a fairly inefficient market, and I think it's still possible to get some pretty attractive returns from an active management there. So I'm not sure if ETFs over the small cap market are necessarily a popular option right now, certainly just because of the illiquidity that's implied in that market.
Great, and we've got one from Emmanuel. It was a few slides back that he asked, are you suggesting that CAPM has broken down? So capital asset pricing model.
No, I think we still need to look at that and think about risk and return and beta and alpha. But the problem is that we have so many different events happening. I gave the example of how oil prices now are positively correlated with with the equity market. And so the historical risk models, we still use them, of course, and they're based on the CAPM model and Monte Carlo simulations as well. But you just have to give them a finer sense check, and you just have to look at risk through a number of different lenses now. You can't just rely on past correlations, because when you think you've designed your portfolio so that it's beta neutral, all of a sudden you find, oh, I have some equity beta in my portfolio that I wasn't aware of. And so that's why we're doing the risk mapping exercises every week to discuss how will the portfolio perform under these conditions, and which ones would we like to hedge out.
Great. And another new question that's come in from Rama. I'll read this one off the screen. Equity options and index options are increasing in popularity by fund managers. Does that mean that the liquidity risk of these instruments are fairly low?
Certainly that's the case. The derivatives market is huge, and so quite often, in fact, the liquidity in the derivatives market of futures or options is far greater than in the physical market. Often we find that we would prefer to implement a position using derivatives rather than the physical, and that's certainly the case in the bond market. And so yeah, if you're wanting to be nimble in your asset allocation, the best way of doing that is through derivatives so that you can move quickly in and out.
Wonderful. Thank you so much. I think we're just about out of time, so we'll end that there. Thank you again, Tracey, for presenting to us all today. It was a really great session. We will be sharing today's webinar resources and CPD details as well as the slides via email, so please do keep an eye out for those in your inbox. As well, our May webinar is coming up. It will be presented this time around by Keith Chu and Nigel Smith from our NetWealth technical team, and that one will be around an analysis of what the federal budget announcement will mean for financial advisors. So we look forward to seeing you there at that one in May. We'll send out the details of that session very shortly. Thank you again, Tracey from UBS, and thank you everybody for staying online today.